Hello, everybody. So everyone's watching commodity markets go up and down, and the Fed acted yesterday, and we're fortunate to have a guest, Tuomas. I've talked to Tuomas many times over the last few years. Welcome to TradeGate Hub, Tuomas. How are you?
Thank you. I'm fine. Glad to be here.
All right. So Tuomas has a doctorate in economics, and he's been advising people. I have to acknowledge that you were telling people that there was going to be a problem with some of the markets, and gold was really one of the only ways to protect yourself in this environment. I know you're also a big euro bear, which short term to intermediate term, I'm going to disagree with you on right here. And I know you're not that doesn't intimidate you. So
no.
I mean,
disagree all you want.
Yeah. Okay. So great topic, because everyone's making the 70s analog that we're going to have high inflation and slow growth. And I think that's the best case scenario.
Yeah, sure, definitely. Yeah, we could if we would have just a bit faster inflation and slow growth, that would be great. Yeah, but I don't think that's what we're gonna get. That's the problem.
All right, so
we're gonna go deeper.
Okay, so you prepared this, and also you're talking about, I believe last time we talked, 6 rate hikes by the Fed. Yeah. So the title of our show is, what I put down?
It was, I had actually, there was a medical emergency downstairs. I had to.
Oh, well, the title.
Okay, so I didn't have time to check it. Sorry.
HUP 1, HUP 2, hike. How many hikes can the Fed's quarterback handle without fumbling?
Yeah. Okay. Yeah.
So you think they could go that far?
That sounds about right. Yeah, for this presentation too. Yeah.
Okay, go ahead. So let's see what you have in some of your evidence, and how you've been advising people, and what we have to look forward to, and maybe how we could turn that into opportunity and protecting ourselves.
Yeah. So this is, as it, like I told you, as it happens, I was just preparing a presentation on this, and then I decided why not to just give it here in a kind of short mode, if you may. And so what is basically the main thesis, how I see the problems here, or how actually we see the problems, are just the enormity of debt in the world economy. And also, I don't have any graphs on leverage, but basically they're the same thing. And the fact is that now that the inflation is coming, or has come actually already, the options the central banks have are gravely limited, and because of the war between Ukraine and Russia, there's going to be another massive inflation shock, and it's going to force central banks to act. And I don't think the world economy is going to be able to withstand that, and not the financial markets at least. But I have just I just have a short presentation here. I think I go through here, but let's see how this goes. Okay, well, this is not moving. Okay, now we go. Okay, so this is the one of the graphs I have been following for several years now. It shows the credit or debt distribution in advanced economies in non-financial sectors.
Okay, so it's not showing that chart. We're still on the headline chart of
interesting
title.
Yeah, that's your screen
so
sharing.
Can you scroll down and click it?
Yeah. Okay, now I think we have to go this now. Do you see it now?
Yeah, we got it.
Yeah, I think we have to go, but manually then. But anyway,
okay.
This shows the distribution of credit in or debt in advanced economies. So we have the general government, non-financial corporation, households, and the not economic participating institutions. And what we can see here is that the credit has been pushing up, or the debt has been pushing up, since all for a long period of time. Let's say the beginning of 2000, basically.
Okay.
And especially the government debt has gone up. And I think you, do you see me changing it or do we?
Yes,
Yeah, okay,
yeah, we
great.
have the balance sheets of central
Yeah,
banks now.
and this is also a massive problem. And if there is another graph which I didn't have time to put here, but when people argue that we had a really spectacular recovery from the coronavirus crisis or the pandemic and the lockdowns,
Yeah,
and it wasn't none of that. It was massive increase in the government, the issuance of
right.
government debt, and also the issuance of central bank credit, which quantitative easing is. So there's a massive leap in this, and it was nothing more the recovery after the corona lockdown. It was nothing more, but debt stimulus all the way, nothing else. And they basically say everything, the world economy with it.
Okay.
And just concentrating on the US, and this is really telling what has happened. So if you look at this is the non-finance sector debt to GDP ratio in the US. So this is the government, households, and non-financial corporations. And as you can see, after the 2008 crisis around it, the growth rate was rather stable with the GDP. And
Yeah.
then there were the corona shock and the lockdowns, and it shot up massively. And now it's gone down a bit, but still it's very high. We are talking about like in the range of 280% debt to GDP ratio.
Is
That's
there any
not,
significance in the fact that it's turned down from looks like 2021 in the last 12 months?
yeah.
Why do you think it has turned down? Is
Well,
it
it's
because
mostly government
okay,
debt.
all
So
right,
and that's influenced by the central banks basically. So, but there's a downturn here, but it's not such a big issue considering a jump. The fact is that there is more in debt than ever in the US economy too. And what is notable here that we don't have the finance sector here. So if you add that, has to be like 200% of the debt to GDP ratio, something like that has to
okay,
be. And
okay,
then you got really massive numbers.
all right.
Okay,
So
and
debt
yeah,
is a time bomb.
that
Okay,
is a time bomb. And then
okay,
what's interesting here is if you look at the junk bonds here, or junk rated bonds, here are the junk bonds in the US, in the
right.
euro, and they have been creeping up since the beginning of the year, basically. Well, and the maybe there is the fact that Fed has been tapering, but this has happened also in the eurozone. So they are signaling something, and the upward trajectory began before the war. So they have been telling something for a bit of time now. Of course, the war accelerated the rise, but there's something they are telling us something, and it's probably that there's going to be many rate hikes possibly.
How about credit quality?
That too. But if you look at the AA and triple B rated bonds, the same is
Yeah,
happening.
right.
So there is
Yes,
something going on.
LQD. I wanted to ask you, Thomas, what do you think about this on the LQD, which is investment grade corporates?
Mhm,
That for the past couple of years, they've gone to the market, most major corporations in a big way because
mhm,
money was cheap and they really didn't invest in plants and equipment, but they were involved in financial engineering where they were borrowing money to buy back stock and pay
mhm.
out dividends. Does that make them long their own stock in a margin account with rates going up?
Well,
That the broker loan rate on their margin account is going up.
yeah, well, that's yeah. We haven't really looked at those in any close detail, but that's basically how it could go. And there is there's a lot of these kind of time bombs in the credit markets, on the stock markets, I'm sure.
Are you worried about a Russian default? Last time
Yep.
on the fall of the Soviet Union, we had a crisis. We had a financial crisis that I think that was long-term capital
Yeah.
went
Managed,
upside
yeah.
down.
Yeah. So that was 98, and that was
Yeah.
that was a domestic default. So Russia defaulted on domestically held debt,
Okay.
which pushed them to a banking crisis. And then there was this heavy the long-term capital management. They had a how did it go?
They were the wrong way
They
on
had
the spread.
a lot of like they used a lot of
Yeah.
leverage in different, and then when the Russian default came, the whole portfolio basically fell under them.
And they were
Uh,
all, superstar economists.
yeah, they were, and they were using, I don't remember the model, but it was a Nobel pricing model which they used
Yeah.
to get the yield, and it just failed spectacularly. It's really a massive failure, and there was a point when the Fed was afraid that it will topple the financial sector.
Huh.
So
So what
that's
do you
like
think now? Contagion in Europe because of
could
this? You
be,
think?
could
Go
be,
ahead.
but
I know you
just
were worried about
there's
your European banks for a long time.
I've been worrying about them for a long time. But let me just, if we go to this, I just
Okay.
quickly
Yeah.
give
Go ahead.
few graphs. So that was the corporate yields telling something, and this is like for a macroeconomist, this is probably the most telling graph I have seen for a while. So this is the Fed funds rate on the red, and U.S. consumer price inflation.
Wow.
If you look at the last bit, it doesn't make any sense. It doesn't make any sense. And if you talk about runaway inflation in the 1970s, but the Fed was, if you look at, for example, 1972 to 1974, Fed was actually ahead of the curve.
Yeah.
And now they are massively behind. So how do you see this will play out? There's nothing good here. And now they raised by what? Quarter of a point. It was a joke. Really.
Yeah.
So
Yeah, well, the dollar sold off on it. Gold came back from being sharply lower initially. Silver as well. Okay.
And just think about this. What happens if we add 2 more months to this and it's over 10%, the CPI? What happens then? What will the Fed do? Will it raise by a 1 point or what? And what if it raises by a 1 point? What happens then? This is the risk that no one is, very few is actually currently pricing in. What if the inflation really gets out of hand? If you look at I don't have the graph, I didn't have the time for, unfortunately, but if you look at the wage growth, for example, in the US, it's very fast. Yes. And then you have massive like inflation pressures coming from all kinds of metals, wheat, energy, it's everywhere.
Yeah.
And what the Fed do if the inflation hits like 10% in April? What will it do? Will it just sit on its hands or raise by by a 100 pace?
Keep tightening till things break.
Yeah, but what options do they have, really?
Yeah.
Do they?
They're going to have to make a decision between the economy and being inflation fighters. Yeah, which way do you think they're going to go?
Well, I don't think it's so simple. It's inflation is very fast. Inflation is very detrimental to the middle class, usually, and it creates all kinds of uncertainty. I think Yeah, I don't, but you know.
I'm a thousandaire.
Yeah, you know. I don't actually, but that's how it goes. Yeah. And this is something we should worry next, really, that the Fed is forced to do something it wouldn't want to do. And I would have liked to have seen a 50 basis point rise now. That would have done something, but they are just too damn scared. Yeah. And you know why? You remember what happened in the turn of 2018, 2019?
Yeah, when he tightened, and then they pulled Bernanke and Yellen pulled him aside, and he flipped, and that's when he should have been. That's when he should have been starting.
Yeah, but you know the actual reason why they made the pivot. What was the actual reason?
I can't remember.
It was the credit markets breaking up.
Oh, okay.
There was near meltdown in credit market. We one of our partners who's in finance, well, deep in finance, let's say in the US, told me that there's pockets within the like the junk bond community when there is no liquidity. So there the threat of a fire sale in the credit markets. That's why they had to pivot.
Okay.
So
All right.
that's and now if you think if you just consider how much more debt there is in the U.S. economy now. Oh, where was the graph? This.
Oh my goodness. Yeah,
Yeah.
since COVID. Yeah.
Yeah. And this is a direct threat. And I think people are talking, yeah, what will there's a threshold of 2%. I say that the threshold is between 1 and 1.5% when everything starts to break up in the
Okay.
financial markets.
You know, and when you talk about stocks right now and equities, Thomas, you know, one of the bullish arguments are there aren't any bulls anymore.
Okay,
All right.
yeah.
So, I mean, because you can't say, well, the Fed's got our back. There's a war going on.
Yeah.
There's slowdown in all kinds of economic indicators.
Yeah.
So really the bullish bet right now is that there are no bulls. And I
Yeah.
feel that too. I mean, everyone hates the market now.
Yeah.
And so, you know, I think people might make the mistake, even though I think we're going to rally, is that it's really not a strong argument for
No.
being long equities just
No.
because everyone hates them.
But let's say if there's a truce now, you know, Russia is taking a hit, and let's say there's a truce. Definitely, there's going to be a rally. I would be massively surprised if there would not. But this is looking a bit ahead, like let's say 2 to 3 months ahead. Where are we then?
Okay, so do you think he's going to call a truce, and is it just to reorganize his troops, realignment, try and make some changes? Yeah,
that's possible, but the war is not going as well as you know, President Putin had planned.
No.
Yeah. So and that was actually, for reasons I'm not gonna, you know, disclose here, I had some very deep knowledge on the capability of Russian army, and this what happened didn't surprise me at all.
Okay. All right. So let me ask you this then. With all of this going on, do you think that there's the worse it goes for him, and he's bringing in reservists, he's bringing up reservists in Russia, he's bringing in mercenary armies from Syria, and the Chechens are there, and he wants the Chinese to back him up.
Yep.
What's the end game here?
I hope that at this point is to that he's already seeking a kind of positions for a good negotiation. I'm not sure.
Yeah.
But there is like too much. There's, you know, I had I'm writing the Epoch Times now, so I had a, you know, column there a week ago where there was a where we wrote about the possible, you know, in economic end scenarios of the war. But at this point, we are actually, as we're writing our March, you know, quarterly forecasting report, we are kind of warning about that we don't know what are the actual aims or goals of President Putin in Ukraine. So there is a lot of uncertainty, and that's why it may even happen that if they have a truce, they just regroup and, you know.
Yeah.
And the point is that what if, I don't think there's going to be a situation where they have a truce and maybe, you know, and then a quick peace where all Russian troops are withdrawn.
No.
There has been this land corridor idea, the annexed Crimean Peninsula for, well, since the 2014.
Yeah, so they wanted this as their first warm water port. Yeah. They finally have it.
Yeah, they finally have it, and, you know, and Mariupol and all those. And what if Russian troops stay there? How about the sanctions? They're probably gonna, you know, stay. And there's all kinds of uncertainties which are now, you know, happening all over the commodity metal financial space that we don't really understand yet. There was just I think it was 2 days ago, President Zelensky said that they are not going to plant anything during this, you know, this planting season, and that would be rather massive hit, you know, the world food production.
30% of wheat and
And then Russia, we had in Finland, like Russia is a major producer of fertilizers. We actually had the company that produces and sells fertilizers here. They stopped selling a week ago, and then they open it up again, but the prices have threefolded from last spring.
Yeah.
And that's gonna,
food, the Fed can't do anything about these things.
Of course they cannot. But the thing is, what happened in the 1970s, that it doesn't matter from where does the inflation shock come from. If it lasts, wages will start to react. They have already done it in US. And then the fast inflation comes self-feeding.
Yeah, I hear that's a shortcoming of the 70s analog of stagflation, because back then it was mainly an energy shock that we've never experienced in energy and food shock simultaneously.
Yeah, but we have the same now.
Huh?
We have the same now.
Yeah, I mean, there was a little bull market in corn, but I think the grains were the last to go, and I was there for the whole Volcker tightening.
Okay,
and everything
that was brutal.
Yeah, but it took almost 18-19% to break the corn market. The Fed was actually watching corn.
Yeah, okay.
Back then, what do you think they're watching now? Gold?
I don't know. I hope they are watching a vast, basket of commodities or something like that.
Yeah.
And U.S. housing, I hope they're watching this. But the thing is that the inflation is coming now. The massive shock is now coming mostly from outside US. So it's really difficult to track.
Yeah,
actually. But there's but these are like big issues, and it should not be, it should be, everybody should be very careful on the idea that Fed could not do something very drastic if inflation really gets out of hand, because now it seems that they are really worried about inflation.
Yeah. And
if it really explodes, then they have to react. It's in their mandate too, especially as there's full employment, like I think it's very close in the US now. There is nothing basically in their mandate saying that they need to keep the financial markets up. But of course they're afraid of that because they have created this massive bubble. Everybody will blame them when it crashes. And they know, so they are scared. And if they weren't scared, I think they would have started the hiking cycle in, let's say, September, October. That waited way too long. They're 5-6 months late. And that's way too much. And the uncertainties, like in the 1970s, there was first there was a Yom Kippur War first, and then at the end there was a Iraq War too.
Yeah, Gulf
so
War.
When the shocks come, you cannot assume that no, this is now it, and then there's nothing. We had the Corona shock, which put in motion the inflation shock, and now we have this. There is no, there could be a third also, something we don't know,
Well, the war, it's a different movie now. Who's talking about COVID anymore? Even when the Chinese shut down their whole country and the most important port. Are you worried about China?
No, not in that retrospect, no. But of course, they can put more pressure on the supply chains. That's for sure.
Okay, but mainly Western civilization on the edge here.
Yeah, no.
And the fractional banking system.
Fractional banking system, and we don't like the Russian. I think their foreign denominated debt is about $150 billion.
That's nothing.
It's a massive exposure. And I think that just the European banks have over 80 billion of claims from the US.
Okay, so
no, from Russia. So it's So these are like, we can do a lot of damage to Russia with these economic sanctions we already have, but there is, if they start to default en masse, let's say, all kinds of stuff can happen, and everything comes back to the fact that our financial system is so highly leveraged at the moment.
Yeah. I mean, I've thought of this. If they default, they're defaulting to the IMF. And who's the IMF?
Well,
basically the US, right?
Yeah.
All right. So, I mean, we're putting on sanctions that you knew could lead to a default, so that we have to pay for the default.
Yeah.
Very,
They might do that.
it's like the Twilight Zone.
It is. And they can default, they can select which bonds they default, for example, so there are all kinds of options. But it's
how are people feeling in Finland about this? Compared to like the Baltic states are all worried, and Poland.
Majority of Finns are just, we have lived next to a Soviet Union true superpower, which did all these kinds of stuff, and every once in a while. So most of us just calm. Of course, there are those who are calling that we not need to go to NATO now and stuff like that. Most Finns are just cool. They know, Russians know, President Putin, everybody knows there's going to be a hell to pay if they come here.
Okay.
So,
all right.
So we're not really worried, except for maybe the economy.
Yeah, and you guys militarily are much more prepared than the Ukrainians were.
Yeah, much more. And
we look at what the Ukrainians are doing.
Yeah, I don't know, and it was really strange in the war, which this has baffled me. So when we on the 12th of February, we warned our customers there might be a serious escalation in a war, and the Finland and or many European countries, the US was drawing diplomats, and there was no. They didn't mobilize. Ukraine didn't mobilize their reserves or the military. That was really strange. Russia there was 200,000 guys, practicing on right next to the border, and they did nothing. How is that?
They wanted to keep the banks open and the economy running for an extra week.
But there's always this line in politics. Like in 1939, Poland was basically tricked in the war by the Britain and on the Western powers were giving guarantees that no, they're going to protect them from Germany, and they didn't.
Yeah.
So this, we don't know what is going on, but really strange things going on.
Okay. So the message to your subscribers is, don't wait to buy gold and wait.
Yeah, I think that now if you want to play, you're a risk player, then I would go long on the stock market for a while, but just to know that it can correct at any time very brutally, and gold should be there now, because this is every time when there is war or something like that, you should have physical gold as a hedge against
more than silver.
Yeah.
Okay. So it's more the chaos hedge.
Yeah. And silver doesn't, if silver works in inflations, but if there's going to be a deflation down the line, then but it's but it's
copper is giving a little bit of a signal here in the last week or so that there's at least a breather in commodities coming.
Yeah, it is, and I think there's some. Everything depends on now what happens on the negotiations between Ukraine and Russia. And if there's a breakthrough, then there's going to be a rally for sure.
Yeah, happy days are here again for till July.
I don't know if it's July. It could be, I don't know.
It could be till Easter.
No, maybe a bit longer.
Maybe
May. But anyway, but it's be vigilant, be careful. That's the idea here, because we're in a highly uncertain world now.
Yeah, so be risk averse, and it's not the return on capital, it's the return of capital.
Yeah, something like that. Yeah, that's a good advice.
Tuomas Mallinen, thank you so much for being with us today. People could follow you on Twitter at MT_Mallinen, and the name of your website again?
GNSeconomics.com.
GNSeconomics.com. Thank you, my friend. Great talking to you.
Yeah,
and
we'll talk to you again.
We will do it soon.
Yeah.
All right. Yeah. All right, everyone. Everyone come out of your bomb shelter. Tuomas is leaving now. Thank you so much, buddy.
Thanks. Yeah. Bye-bye.
All right. Adios.